The US stock indices continues to stage a strong bullish tone for the second consecutive trading session, led by the Russell 2000, and both the S&P 500 and the Dow Jones Industrial Average soared to fresh all-time high yesterday. In Asia, today's trading session, mixed performance was seen across the Asia Pacific benchmark stock indices, with the laggard being the Hang Seng and the China's related benchmark stock indices, facing a slew of profit-taking activities as we are speaking right now after 3 days of strong performance. The US dollar will mix, and the West Texas crude oil didn't break above its 20-day moving average and staged a bearish reversal yesterday. Lastly, gold XAU/USD rallied but continued to face some form of struggle at the 4,500 psychological level. Very good morning to all. Welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Today will be Wednesday, the 7th of July, 2026. So let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so as usual, before we jump straight into today's full slew of the daily dose, which I will cover the broad-based asset classes ranging from the FX, ranging from the major stock indices, and as well as the two key commodities market, XAU/USD, which is gold, and the West Texas crude oil. Let us take a step back first and do a bit of recap what has taken shape yesterday, all right, in terms of price action movement and the relevant news flow. So let's start with the relevant news flow first, all right. So yesterday, we do have two relevant news flow and economic data releases that I would like to share with you guys. Will be the release of Germany and France preliminary inflation data. Why this data is important? Because it has an impact on the euro dollar. And let me very quickly share you guys yesterday over here. So France and Germany being are the two key anchor economies for the Eurozone bloc. So yesterday, France released the harmonized inflation rate year-on-year and the analyzed data for the month of December. So that came in slightly below expectation. So market is expecting at 0.8% year-on-year over here. Give me a minute. It seems to be, I think everything should be fine. All right. Okay, so just to very quickly make sure that, yeah, it should be fine. All right, good. So the inflation data, the harmonized inflation data, it came in, this one over here, it came in slightly below expectation for the France economy. So market is expecting at 0.8% year-on-year for the month of December, and it came in slightly below expectation at 0.7%, also below 1 basis point of the previous month of November print that was at 0.8%. But if you go down to the Germany one, it came in, the spread was much wider between the actual and the expectation. So the Germany harmonized inflation rate, okay, taking its form that harmonized is actually core inflation rate. That's how the Eurozone economy frame it. So for the core inflation rate / harmonized rate in Germany, the analyzed rate preliminary figure for December, it came in below 2 basis points below expectation. So market is expecting at 2.2%. It came in at 2% and also way below the previous month print of November at 2.6% year-on-year. So that actually causes the euro to sell off during the European session, but managed to find some support at the start of the US session. So it's more of a yo-yo over here. So what you could see over here is that if you were to look at the 5-day performance of the US dollar against other major currency as we are speaking right now, we see the the dollar against the euro is actually up by 0.41%, trading much higher than the dollar index, which is up 0.31% based on the 5-day rolling performance basis. But however, there's no clear strength of dollar strength against in the FX market right now, because we continue to see dollar weakness against the Aussie. So based on the 5-day rolling performance, so why do I do a 5-day rolling performance? Because it's able us to see a bit of a trend rather than a 1 day where it's much more volatile. So based on this 5-day rolling performance trend, it's a very short-term trend in the FX market. The I repeat, there's no clear there's no clear dollar strength in the FX market. So what we could see now is more of a mixed bag. But however, we see very clear signs of dollar weakness against the Aussie, which is down by negative 1.10% based on the 5-day rolling performance basis. And that dollar weakness also being translated to its Ethiopian cousin, which is the dollar against the Kiwi, where the dollar is down by negative 0.56% against the Kiwi currency, which is the New Zealand dollar. And followed by will be the dollar Sing, down by negative 0.33%, and the dollar against the sterling pound, where the dollar is down by negative 0.3% against the British pound over here. So like I mentioned, I recall yesterday, the chart of the day will be the Aussie dollar. So Aussie dollar continues to be a very strong bullish momentum. So despite the fact that there's one particular news flow that came out in today's early Asia session, which is the release of that Australia annualized CPI data for the month of November. All right, so let me share you guys. Yeah, so this is the data over here that was released early morning at 8:30 a.m. Singapore time. So what I could see, this is the RBA trim mean CPI data. So I focus more on the trim mean because it's considered as a core inflation data, stripping out from the so-called the much more volatile items like food and energy. So the trim mean data over here, it came in at 3.2% over here, slightly below the previous print of 3.3%. All right, and trading economics forecast at 3.1%. So it came in slightly above the expectation. So at 3.2%, if you were to open up the trend over here, so very clearly it continues to trend upwards since the low or the trough of June 2025 at 2.8%. All right. So given that since the middle part of last year, the Australia inflation trend has slowly tricked upwards, and being at 3.2% for the month of November, that is still way above the desired upper limit target of the long-term inflation rate target that RBA wants to achieve, which is at 2% to 3%. So that actually explained to us why the Aussie dollar is trading much of a firmer footing in today's Asia session, and being the Aussie dollar is the currently the best performing currency against the US dollar among the major US dollar pair based on the 5-day rolling performance. All right. Now onward next will be the stock market over here. So let me show you the stock market. If you look at the stock market yesterday, we see a very strong push up in all the major US stock indices after the first hour of trading session get underway, which is at around 12 a.m. Singapore time, which is early this morning. Right, so based on 12 a.m. Singapore time, all the stock market, all the major US stock investors managed to stage a minor bullish reversal. So this was being seen on the SPX 500, the Nasdaq 100 as well, the Dow Jones Industrial Average, and as well as the Russell 2. Okay, the Russell 2000. Let me put it up this over here. Of course, there seems to be an error. The Russell 2000 as well at the 12 a.m. mark. So net overall, very interestingly, if you look at the performance on a percentage basis, the prior laggard of the last 2 years continues to outperform, which is the Dow Jones and the Russell 2000. So the Dow Jones is up by almost 1%, the Russell up by 1.37%. That managed to inch slightly higher than the magnitude of the Nasdaq 100, up 0.94%, and the S&P up 0.62%. So if you look at the heat map of the S&P 500, very clearly we see much more green in the industrial sector, and as well as the healthcare. And what we could see over here, even the basic material, and we see some slew of red in the mega cap technology sector, where Apple underperformed yesterday, down by negative 1.83%, and Nvidia down negative 0.47%, and Google down negative 0.87%, and even Tesla is down by a whopping negative 4%. So that actually explained to us that the certain components inside the mega cap technology sector is now lagging behind the general market. And very clearly, if you look at from a sectorial performance basis, we see the strong performance in the basic materials up by 2.76%. And one of the reasons why basic materials has been on a very strong footing since the last 5 days ago, even before the start of the year, was the fact that copper prices continues to inch upward. And yesterday, copper prices rose to a fresh all-time high due to a threat that is being introduced again to the market, where the Trump administration now is pondering to impose tariff on refined copper. So that's what explained to us that continuation of this positive feedback loop into the basic materials sector in the US stock market, driven by this ongoing bullishness in copper prices, and followed by healthcare and industrial up by 2% and 1.21%, where healthcare and industrial has a very significant weightage in the Dow Jones Industrial Average over the S&P and the Nasdaq 100. So that explained to us a bit of what I call it sector rotation into play, where right now, in my own opinion, that potentially this year we may see the year of the laggards. That means, i.e., the Dow Jones Industrial Average and the Russell 2000 outperforming those heavy technologically weighted centric indices like the Nasdaq 100 and the S&P 500 over here. Then going into next will be the Fed speak yesterday. So yesterday we do have a US Federal Reserve official spoke publicly, Fed banking. So he sees a delicate balance. So what does it mean overall? He in fact, based on the summary over here, Federal Reserve Tom Banking said that the outlook for monetary policy remains in a delicate balance, giving the conflicting pressures from rising unemployment and still high inflation. So what it means that he offered much more of a neutral stance, neither supporting the dovish camp or the hawkish camp, and that actually didn't change much the Dow on the expectation being priced in by CME Fed Watch, by the CME Fed Watch 2, taking into account of the latest price action of the Fed Funds futures traders in the Fed Funds market. So based on the latest CME Fed Watch data, so market participants are still assigning a high odds of 82.8% that the Fed will not move on the upcoming meeting, which is on this month on the 28th of January. So they will stand pat and maintain the Fed funds rate at 3.5% to 3.75% range, where they cut the Fed funds rate for a third time last year, and only a small chance of 17% that the Fed may do another fourth cut of 25 basis points. But if you go down to the calendar, market are still pricing in at least 2 interest rate cuts for this year. So the Dow doesn't change much, given that neutral statement that's being made by Fed banking yesterday. So if you look at the Fed Watch 2 again, so market participants is assigning a chance of a coin flip of 53% for the next meeting, 18th of March this year, for the Fed to introduce the fourth cut to bring the Fed funds rate down to 3.25%. But higher chance will be on the April and the June meeting, which is at 74% chance and 72% chance. Then thereafter, we see a 64% chance on the 29th of July meeting, and a higher chance of almost close to 100% on the 16th of September meeting this year. So net overall, by the end of this year, on the last meeting, which is the 9th of December 2026 FOMC meeting, market participants are assigning a 70% chance that the Fed funds rate will be at 3% to 3.25%. So i.e., taking into account of the current rate at 3.5% to 3.75%, and based on the current expectation that's being priced in by the Fed funds futures traders, where they expect the Fed funds rate to end at 3% to 3.25%, it means that at least 2 interest rate cut is being baked into the markets right now. The markets, I'm talking about the Fed funds futures market. So overall, we are still seeing a potentially ongoing interest rate cut cycle. It's only that whether the intensity of this interest rate cut cycle will change, and that pretty much dependent on the latest slew of key economic data that's going to be released this Friday, which is the non-farm payroll data, and as well as the University of Michigan data, which I will cover as the daily dose goes by in the next couple of sessions. All right, so that sum up the first segment of the daily dose. So let us now go through the second segment, which is the intraday technical outlook on all those broad-based cross asset classes. So before that, let me expand my screen. All right, over here. So let us now take a look at the FX market first, starting with the euro dollar. So what's interesting over here is that the euro dollar, yes, it slid over here during the start of the European session. Then thereafter, it managed to find some kind of support during the last 2 hours of yesterday's New York session. And also the hourly RSI has managed to strip a higher low as well. And where it managed to bounce, at this dotted turquoise green line over here. So what this dotted turquoise green line, it's actually, if you go to the 4-hour time frame, it's in fact this medium term ascending channel support, that a minor ascending channel support that I drew from the low of 5th of November. All right, it's the median line, so it's the middle of the ascending channel. And what's interesting over here is that this bounce also confluence with the 50% Fibo, around the 38.2% Fibo retracement over here of the prior minor impulsive up move sequence from the low of 21st of November, drawn from the high of 24th of December, where it managed to do a pause and form a higher low right at the 38.2% Fibo retracement. So indicating that this potential move from the low high of 24th of December all the way down to the minor swing low of 5th of Jan, which is the start of this new trading week or full trading week for 2026. It's more of a corrective decline rather than the start of a medium-term downtrend phase for the euro dollar. So with that, I will have a pivotal support for today as adjusted a bit of excess from yesterday. Yesterday, I have won a very tight one at 117 figure. So I'll use 116.80, torn a bit of excess. So using 116.80 as my short-term pivotal support on the euro dollar, still have this potential bias for at least for a intraday minor bullish reversal to take shape for today on the euro dollar, with the first resistance level to watch will be something like an upside trigger level at 117.28 over here. I put in writing 117.28. all right, which is so confluence with the 20-day moving average, and also this particular failure bullish intraday breakout above the 20-day moving average, where it can't maintain the momentum and start to see the intraday sell off during 5 p.m. Singapore time as the London session gets underway yesterday. So this will be a very clear, we call it a psychological level, in order for the bulls to overcome, to gain much more better traction, in order to have a higher odds of a minor bullish reversal scenario that we tend to anticipate for today, using 117.80 as my short-term pivotal support level. A clearance above 117.28 may open up scope for the next intermediate resistance to come in at 117.65, which is the minor swing high of 31st of December and 2nd of January. Only a bearish breakdown below 116.80 will see further weakness to expose the 50-day moving average that is acting as a near-term support level at 116.50, as the next near-term support level at 116.50, 116.40, 116.50, 116.40, maximum 116.16, which is the minor swing low of 8th of December and 9th of December. So that's for the euro dollar. All right, so before that, let me expand this screen here so that you guys have a better view of the next few charts. Next up will be the sterling pound. So the sterling pound continues to trade within this minor ascending channel since the low of 3rd of December, and managed to see a higher low over here after that rebound of that intermediate support that I highlighted on Monday at 135 figure level, and it still can't break above a 135.55, 135.80, which is the minor swing high that was being formed on on Tuesday, yesterday, all right, Tuesday. So net overall, given that it can't have a breakout above 135.80, I do not want to tighten my pivotal support to be so tight at 135 figure. I'll be using 134 for 134.60. So 134.60 is the minor congestion area here that's being formed of the 2nd of January and early on this Monday US session. And so that confluence with the lower limit of this minor ascending channel as well at 134.60. So using 134.60 short-term pivotal support on the sterling dollar, maintain that bullish bias. First resistance level to watch will be 135.55, 135.80. A clearance above it exposes 136.20, 136.35 in the first step, which is a Fibo extension level at 2 times Fibo extension, taken from the low of this second double bottom of 20th of November, and also confluence with the upper limit. Okay, very close to the upper limit of this ongoing minor ascending channel drawn from the low of 3rd of December. Only a bearish breakdown below 134.60 and hourly close below it will negate this bullish tone on the sterling dollar to see a minor corrective decline unfolding to retest the 20-day moving average at 134.30, 134 figure level. Only a breakdown below 134 figure level will unleash a corrective decline sequence a minor one in the first step for the euro dollar to retrace back down towards the 20-day moving average and close to the 50-day moving average, confluencing with the near-term graphical support at 133.65, 133.25, which is the minor swing low of 17th of December. So that's for the sterling dollar. All right. Onward next will be the Aussie dollar over here. So let me expand the screen. So for the Aussie dollar, it continues to shape a very strong bounce after this minor bullish breakout, very clearly that taken out from the stubborn minor range top of 24th of December and 29th of December. And interestingly, in today's Asia session, it managed to retest and stage this minor bullish reversal. So given that it's now coming very close to the resistance level at 67.60, so if we start to see a clearance above 67.60, then I will tighten my pivotal support level to 67.18. So right now I'm using a slightly adjusted pivotal support that confluence with this former minor swing high area of 2nd of January, and also confluence with the lower limit of this minor ascending channel from 21st of November 2025 low that will be at 66.95. So as long as 66.95 adjusted pivotal support holds, still continue to maintain that bullish bias on the Aussie dollar. After 67.60 will potentially expose the psychological level or 68 figure level. That also confluence with a Fibo extension level of 0.764 of this ongoing bullish impulsive upmove sequence from the low of 21st of November. And after 68 figure level will be 68.30, 68.45, which is a Fibo extension level taking from a smaller subset of 18th of December, project it up to the high of 29th of December and push it down to the intraday low of 31st of December. That confluence with the 1.236 and 1.382 Fibo extension, and so confluence with the upper limit of this ongoing minor ascending channel from the low of 21st of November 2025. That will be at 68.30, 68.45. Only a bearish breakdown below 66.95 will negate today's bullish tone to see a retest at the rising 20-day moving average, confluencing at the graphical support zone, the next intermediate graphical support zone at 67.70, 66.60, defined by the minor swing low area of 1st of Jan and 5th of Jan. So net overall, do keep a close eyes watch on the Aussie dollar as it continues to trade firmly, holding above our key pivotal support level. So for now, pivotal support level 66.95, unless we have an hourly close and a breakout above 67.60, then I will tighten it to this pivotal support area at 67.80. So that's for the Aussie dollar. Next up will be the very choppy dollar yen over here. So dollar yen continues to chop around over here, can't break out above the this week high, which is the Monday's minor swing high at 157.28. So what you could see over here, this is something like a failure bullish breakout over here at this Monday. Can't maintain the momentum, came down, traded lower during the US session, during Monday European session, then thereafter attempting to push up back again, but can't maintain that momentum and just traded sideways yesterday. So with this kind of very choppy, lackluster movement, a directional movement on the dollar yen, I have no conviction for any directional biasness right now for the dollar yen. So hence I will have a neutrality stance for today. 157 figure level for sure, given the failure bullish pop-up earlier on this Monday, and the lower limit will be at 155.90. That confluence very closely with the 20-day moving average, where it managed to find support since testing it on 30th of December last year. So neutral between 157 figure and 155.90 for now on the dollar yen. And that sum up the intraday technical outlook on these four major US dollar pair. So now let us now proceed with the major stock indices, starting with the Asia Pacific stock indices, which is the Hong Kong 33. Still recall that yesterday Hong Kong 33 was featured as my chart of the day, but I do highlight that Hong Kong 33 is coming very close to our resistance level, which is 26,920. Then there could be a risk of a pullback, and the pullback indeed takes shape yesterday US session, and right now in today's Asia session there is an intraday sell-off. And more interestingly, this intraday sell-off paused exactly at our pivotal support level at 26.44. So for today, I'll give a bit of access at 26.310. So given that the hourly RSI also now bouncing up from a parallel ascending trend line that has been in place since the low of 29th of December, giving some form of comfort that the bulls are still in control from an intraday basis. So with that, looking for a potential inflection point that is now taking shape right now for at least a minor bullish reversal to take shape for the Hong Kong 33. So 26,440, 26,310 short-term pivotal support zone for the Hong Kong 33 that is representing the Hang Seng Index, maintain that bullish bias. Two key levels to watch out for from an intraday basis over here. The first intraday level to watch out for will be this high, 26,656. Let me put it in writing. 656. All right. So this 26,656 is also the start of the opening intraday high for the Asia session. All right, over here at the 9 a.m. Singapore time today, 7th of January, as we are speaking right now, 11:28 a.m. Singapore time. So 26,656, first intermediate resistance level to watch to maintain our intraday potential bullish bias scenario. A breakout above 26,656 will see a retest on 26,920 in the first step. Only a bearish breakdown below 26,310 will see a deeper minor corrective pullback unfolding to retest this 26,197/26,107 level, which confluence with the 50-day moving average and as well as the former minor double bottom neckline resistance of this dotted gray line now turns into a pullback support also at 26,107. So that's for the Hong Kong 33. Next up will be the Japan 225, which represents the Nikkei 225. So the Japan 225 rally as expected over here, and right now is it did a pullback over here, and the pullback stopped at around this 51,988 during yesterday's US session, and in Asia session it now attempting to do a bounce. So given that it hasn't cleared above the first resistance level at 52,775, 53,045, which is a Fibo extension cluster level and very close to the current all-time high at 52,657. So only a clearance above this resistance zone at 53,045, the upper limit, then I will tighten my pivotal support to 51,988. So right now, pivotal support will be the former minor range stop of 4th of November and 13th of December that got decisively taken out on this Monday. That will be at a pullback support of 51,533. So using 51,533 as my short-term adjusted pivotal support on the Japan 225, representing the Nikkei 225, pardon me, still maintain that ongoing bullish biasness. Next resistance level to watch after 53,045 will be next Fibo extension cluster level that will be at 53.38, and also the trajectory of this ongoing minor ascending channel that is now forming since the low of 13th of December, 18th of December last year. All right, let me push it up. All right, it's close to this level as well. Right, as it project it ongoing forward. Only a bearish breakdown below 51,533 with an hourly close below it, then that would invalidate the direct bullish biasness on the Japan 225 to see another round of minor corrective decline to retrace back down towards the lower limit of this minor ascending channel, and also the rising 20-day moving average, with the next two intermediate resistance level to watch will be at 51,050, 50,720. All right, so that's for the Japan 225. Onward next will be the Germany 30 over here, representing the German DAX. So the German 30 and the German DAX continues to rally strongly as expected, now hitting our second resistance that we have at 25,065 that we highlighted on Monday over here. So what we could see over here is that as it approached this resistance level, very clearly right now there is some form of bearish divergence that has taken shape on the hourly RSI. Notice there's this bearish divergence over here. Okay, price action shape a higher high, but the hourly RSI shape a lower high over here after hitting the overbought level yesterday. So with this bearish divergence in mind, there could be some form of consolidation taking place on the Germany 30 for today. So for today, I will not be so aggressive to maintain my bullish bias stance that we have for Monday. So for today, for the Germany 30 that's representing the German DAX, I will have a neutrality stance for this potential consolidation that may take shape, given that the resistance level is almost being met at the upper boundary of this ongoing minor ascending channel drawn from the low of 21st of November, and with the bearish divergence that's being flashed out on the hourly RSI. So I'll have a neutral stance for today. Okay, let me remove all this, put it in a proper writing. Okay, so this will be my neutral zone. 24,670. Okay. Neutral between 25,065 and 24,670 over here. So let's say if it starts to do a bullish breakout above 25,675 by not doing much of a deep consolidation, then I'm going to respect that bullish impulsive upmove sequence. Then the next resistance level to come in will be the next Fibo extension cluster level, the one-time Fibo extension from this ongoing bullish impulsive upmove sequence from the low of 21st of November that is still intact. So that'll be at 25,433 right over here. So let me put it. Choose the text. 25,433. Pardon me. 25,433. Okay, put it in writing. 25,433. And if you want to do a subset of this Fibo extension level, we draw from the low of 18th of December. Right, project it up to the next meaningful pullback, which is taking shape on 29th of December. And that also confluence with the 2 times Fibo extension of this subset, right? Making 25,433 as an important resistance level to watch on a near-term basis. So for now, neutral between 25,065 and 24,670 due to the bearish divergence that's being formed on the hourly RSI for the Germany 30. All right, next up will be the major stock indices, starting with the we call it a high flying outperforming US Wall Street 30 CFD, which is representing the Dow Jones Industrial Average. So the US Wall Street 30 was featured as one of our so-called chart of the day yesterday, and it managed to clear both resistance at 45,425 and 48,280 over here. All right, so it managed to clear up both these resistance. So with that, I would tighten my pivotal support for today to this minor swing high area here at 48,250, 48,280, all right, or 48,250, I would say. Okay, 48,250. So this will be my short-term pivot. Here, so let me remove. This will be a normal support level. Come on. Okay, so tighten my pivotal support level for today at 49,250 over here, 49,250. So as long as this 49,250 hold, I will still maintain that bullish bias on the US Wall Street 30. Resistance level to watch out for today in next step will be at 49,805, pardon me, 49,840. So I repeat again. So given the very sharp up move, hitting our resistance level, so from a risk management perspective, I would still maintain that bullish bias, but using a rather tightened upward adjusted short-term pivotal support at 49,250. Next resistance level to watch will be 48,840. It's Fibo extension cluster level, and the next Fibo extension cluster level after 49,840 will be at this 50,265, 50,334. Okay, let me put it in writing. 50,265, 50,265 slash 335. Okay, just to make sure everything is correct. No typo error. 50,265, 50,335. All right, after 49,840 is taken out. Only a bearish breakdown below 49,250 will invalidate today's direct bullish bias view to kickstart a minor corrective decline to see a minor retracement to retest back above the former minor swing high area or the minor range stop of 12th of December and 25th of December. Now turns into a critical near-term pullback support level at 48,770, 48,840. 47,870, 48,770, maximum 48,480, which is the rising 20-day moving average. So that's for the US Wall Street 30. Next up will be the S&P 500 over here. So S&P 500 surpassed its current all-time high slightly at 6,953. So with that, given that it can't have a clear bullish breakout above 6,953, I do not want to tighten my pivotal support to be so tight at 6,625 and 6,900 figure level. So I'll be using this as a potential pullback area for me to maintain that bullish bias. But pivotal support maximum pullback area tolerance level to be allowed will be at 6,870, which is clearly the 20-day moving average and also confluence with the lower limit of this ongoing minor ascending channel drawn from the low of 21st of November. So using 6,870 to maintain my bullish biasness in any form of minor pullback that may take shape today. Next resistance level to watch will be 6,000. I think the next resistance level to watch, pardon me, above 6,935 will be 7,100. 7,000/7,005 FIBO extension cluster level. Only yeah, this is the FIBO extension cluster level 0.764. So only a bearish breakdown below 6,870 will invalidate today's bullish biasness to see a deeper minor corrective pullback, exposing the 50-day moving average that confluence with the next intermediate graphical support level at 6,822, maximum 6,780. So that's for the SPX 500, still maintaining that bullish bias with a short-term pivotal support at 6,870. Next up will be the Nasdaq 100 over here. So the Nasdaq 100 finally managed to clear above this minor swing high area of 30th of December and 2nd of January, but still can't break above the rather stiff range resistance that has kept previous rally in play since the early part of December last year, which is 8th of December. So given that it hasn't cleared above this stiff resistance level, which is at 25,760, 25,830, I don't want to tighten my pivotal support to be so tight. So I will put it up at 25,350, slightly adjusted upwards for Mondays, 25,350, which confluence with the 50-day moving average and so confluencing with the lower limit of this minor ascending channel drawn from the low of 21st of November. So using 25,350, slightly adjusted upward short-term pivotal support on the Nasdaq 100, still maintain that bullish biasness. A clearance above 25,830 will increase the odds of another round of bullish impulsive upward sequence for the next intermediate resistance to come in at 26,070 in the first step. Only a bearish breakdown below 25,350 will invalidate today's bullish biasness to see a choppy minor corrective decline sequence unfolding, retesting last Friday minor swing low at 25,133. A breakdown below it may expose 24,870 next. So that's for the Nasdaq 100. And also sum up all the intraday technical outlook for the major stock indices. Let us now move on to the commodities market. Over here, starting with the Gold XAU/USD. So for Gold XAU/USD, there's a bearish reversal that is being formed at our pivotal resistance at 4,485, a bit of excess at 4,500 over here, /500, with this ongoing bearish divergence that's being flashed out on the hourly RSI. So with that, I'll still maintain that short-term intraday bearish biasness on Gold XAU/USD, tolerate a bit of excess at the 4,500 level, 4,485/500, 4,500 short-term pivotal resistance. First resistance level to watch will be at this 4,430, 4,403 level over here. Okay, let me put it in better writing of 430/403. Okay, which is the former minor swing high of 2nd of Jan and 30th of December now turns into a pullback support. A breakdown below 4,403 potentially take us down potentially further to the gap up that's being formed on Monday, and also the minor swing low of last Friday at 4,333, 4,309, which will correspond around the 20-day moving average. A clearance above 4,500 will potentially eradicate this short-term intraday bearishness on the gold to see a retest at the current all-time high at 4,550, 4,560. So that's for gold. Lastly will be the West Texas crude oil. So the West Texas crude oil tumbled down as expected, which I have my pivotal resistance earlier on Monday at 58.76, 59.18. Hit our support level at 55.75, which is the minor swing low area of 19th of December. And with the hourly RSI now back at the oversold level. So potentially right now for West Texas crude oil, this could be a consolidation as well. A kind of a sideways consolidation, and where it stopped exactly at the pullback of the 76% FIBO retracement taken from the rebound that was seen on 16th of December, push it all the way up to the high of 26th of December. That's 76.4% Fibo retracement. So potentially right now it's coming down towards the lower edge of this complex sideways range configuration, and it may do another mean reversion rebound to retrace back up towards the upper limit of this complex sideways range configuration that's being kept by the 50-day moving average. So with that, I will flip to a intraday bullish bias stance for today to take advantage of this potential range trading environment for the West Texas oil, given that it's not at the lower limit of the range. 55.75 short-term pivotal support level for West Texas oil. Flip to a intraday bullish biasness. No clear signs of a major double bottom yet that's being formed. All right, we're taking things one step at a time. First recent level to watch, 56.80, a breakout above 56.80, potentially shift the pendulum back towards the upper limit of the range at 57.74 and 58.20, which is the 76% Fibo retracement of this ongoing slide over here. Okay, 76% Fibo retracement. All right, only a bearish breakdown below 55.75 will see a further weakness being exposed towards 55.23 and 54.50 next. So that's for West Texas oil, and that's also sum up all the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar to see what key data to look out for during the European session today. All right, so stretching out during the European session, what do we have over here is we have a couple of Germany data to take note of. Will be the retail sales up at 3 p.m. Singapore time, as well as the unemployment rate at 4:45 p.m. Singapore time. So that could potentially influence the Germany 30 CFD index. And heading into the later part of the session at 6 p.m. Singapore time, we do have the aggregated Eurozone core inflation rate data. It's a preliminary reading. Core inflation rate data annualized for the month of December. Market is expecting it to be on the same rate at the previous print of November at 2.4%. So that could potentially influence the euro dollar and the euro crosses pairs. And heading into the US session, you have the all-important ISM services PMI up at 11 p.m. Singapore time. So why ISM service PMI is important? Because the services industry or the services sector in the US contribute close to 3/4 of US GDP growth. So therefore, it's kind of indicating the health of the US economy. So market participants are still looking at a rather not really downbeat number, but kind of a very tepid expansion, hovering around the 51 to 52 level in the last 3 to 4 months. So market expecting is at 52.3, slightly below the previous month of November of 52.6. So as long as it's not too hot, coming in at 55 or 56, hovering around what is market is expecting, between the 51 and the 52 range, that could allow the US economy to expand modestly and also allow the Fed to maintain its interest rate cut cycle, given that there is no rate hot economic growth in the US economy yet, given that the services PMI data is a leading US economic indicator. That will be at 11 p.m. Singapore time. And thereafter, you will have this weekly EIA crude oil stockpile change that could influence the intraday movement of the West Texas crude oil. That will be at 11:30 p.m. Singapore time over here. All right, so that sum up today's Daily Dose of Market Insights. I'm Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.